Good morning, everyone, and welcome to the last interview of this academic year here at Room for Discussion. The person we're interviewing today is at the very top of the European banking supervision system. She's the person that decides what financial stability means in an age of instability. Claudia Buch is the head of the European Single Supervisory Mechanism, the body that oversees over 100 of the euro area's biggest banks.
She's also the chair of the European Central Bank's Supervisory Board, which means that when we think about financial stress, she is the one making decisions that shape the course of Europe's economy. And these are not quiet times. Tariffs are back in headlines. Political risks are bleeding into market risks. And lines between politics, global power games, and supervision are becoming blurrier by the day. How do you supervise in a world that won't stand still? We'll try to answer this question today, and without further ado, let's welcome Chair Claudia Buch on our stage.
Good morning and welcome to our couches, Chair Buch. It's a pleasure to have you here. In contrast to many other key figures of the European banking system, your background is rooted in academia and public policy compared to the private banking sector. We were wondering, how does this background influence your view on supervision?
Well, thank you very much, first of all, for having me here. It's a wonderful setting, and I'm glad, as you said, my origins also in research, academia, think tank, so I'm glad to be here in a university setting and to speak to you and discuss with you. Well, actually, I would say that the step from more academic work, teaching, to supervision and doing public policy work is actually not that big. So in the end, we are all interested in having, as you said, a stable financial system, making the best contribution as a researcher, as a teacher at the university. You give your knowledge to the students. And then at some point in time, you decide you want to apply this more and you want to make sure that actually the ideas you had, the evidence you collected with your research is actually put into practice. And so this is what I'm doing now, trying to apply the best knowledge to the work that we do. And I must say, because you said nicely at the beginning that I'm in charge of taking all these important decisions. But of course, I rely also a lot on the work of the people working within the SSM, the Single Supervisory Mechanism, within the ECB. So we have great analysts, and we work very closely also with the people in all the countries that are under the roof of the SSM. So this is a big united effort, and I'm really proud that I can be part of this.
And you're also in quite a unique position as a chair of ECB Supervisory Board, SSM. Could you explain to us how these two fit into this broader supervisory landscape, and how do they differ in times of crisis?
Well, I mean, first of all, what is the SSM, the Single Supervisory Mechanism, about? I think it's really a great European response to the global financial crisis and also the European sovereign debt crisis, when it became very apparent how risky it can be if banks are not sufficiently regulated and supervised, how risky it can also be if we organize supervision just at the domestic level, because then it's very difficult for the supervisors to actually compare, to see how do their banks perform relative to others. So a big political decision, I think, was taken more than 10 years ago to bring supervision under European responsibility. It's located within the ECB. It's separate from the monetary policy function of the ECB. That's very important. So we have a separation principle. And to say we want to supervise banks from a European level and make sure that we apply the same standards. We can benchmark banks against each other. And as I said before, we're not doing this alone in the ECB, but with the work of also the national competent authorities, how we call them, the authorities in all the countries. So that's what supervision is about, one important part of the banking union. But then supervisors do all their best to make sure that banks don't fail, that there's no distress, but we can't avoid banking crisis. So there's many also external factors that can come into play. So we also have within the banking union, because you mentioned crisis, no? We can reduce the probability of crisis, the severity of the crisis, but not necessarily avoid them. So this is now why we have a single resolution mechanism. So to make sure we also have tools in place, funding in place, in case banks come into distress, that we can deal with those problems as well.
We're wondering, God, okay. And on your day-to-day basis, how do your personal responsibilities differ between the two roles?
The two roles, you mean supervision and resolution, or no?
Yeah.
Yeah. Well, we don't have the resolution responsibility. So my day-to-day work is to make sure that the single supervisory mechanism is running well, that the colleagues working for us, prepare the supervisory decisions, that we have good monitoring frameworks in place. So basically my day-to-day role is, of course, to work with the colleagues that work in the ECB, and also, as I said, the colleagues working in the different countries. And then I'm chairing the supervisory board, where basically all the supervisors from the countries come together. In some cases, it's also the central banks from the countries represented, because supervision is often a shared responsibility. And the supervisory board takes decisions on how we organize our work, takes decisions on relevant for the individual banks, and those decisions also then need to be approved by the governing council of the ECB. So this is also where the ECB is as a whole is being involved.
Thank you. We'd now like to zoom out a bit more. So incorporating geopolitical risks has been called the defining challenge for financial stability today, with multiple shocks overlapping from Ukraine to climate to tariffs. What areas does the ECB prioritize right now for systemic stability, and what is maybe deprioritized?
Yeah, so that's, as you said, there's so many challenges right now that it's really difficult to decide what to prioritize and what to deprioritize. At the same time, you have to do that, because you can't do everything at the same time with the same intensity, then you're overstretching the resources. So we indeed have a very defined process to set our priorities. And as you rightly said, one of our main priorities right now is to make sure that the banks are resilient against macro-financial risks and also geopolitical risks. So maybe later on we have a little bit more time to talk about what we mean with geopolitical risk, because there's many aspects, of course, of it. So that's the first priority we have right now. The second priority is to make sure that governance systems of banks are appropriate and up to speed. And in that priority, we also have one particular aspect, which sounds maybe a little bit technical, which is risk data aggregation. And now you may ask me, what is risk data aggregation? So this is basically about the internal information systems that the banks have, so that they inform bank management, but also us about what is the risk profile of the banks, what requires attention. So this is an area where we've seen deficiencies, and we want to make sure that these deficiencies are being remediated. So we have a strategy also for that. And then there's a third priority in the current cycle, which is digitalization. So a lot is happening, not just about geopolitical risk, but also about digitalization of financial services. And here again, the banks, of course, have opportunities. Many more things one can do, maybe in a more efficient way, but it can impose risks on the banks. So we want to make sure that the banks have good strategies for dealing with digitalization. You also mentioned climate, and you may say, why is climate not a priority? Well, climate is actually a priority. So we had it over the past years. We've worked a lot with the banks on improving their readiness to deal with climate-related risks. So this is really something that's very important to us.
We would like to stay in the topic of those geopolitical risks. And at the 2024 European Systemic Board Conference, you said that geopolitical risks require a framework for dealing with not just known unknowns, but unknown unknowns. Yet, many people look at the past crises, they look at the global financial crisis, Eurozone crisis, they look at COVID crisis, and they think those macroprudential tools are usually reactionary, not forward-looking. Do you think that those tools that the supervisors have can truly be forward-looking then?
Yes. So the short answer is yes, but let me be maybe a bit more specific. What we consider geopolitical risk to be. I think this is important. So we defined, as you said, this framework for assessing geopolitical risk already last year. This has also been one of the main themes the ECB and supervision has been thinking about. So basically, geopolitical risk is very broad. It can come through the financial risk channel. So if there's a sudden repricing of risks on markets, the banks need to be prepared, and this can be in response to different types of geopolitical risk events. There's also a real economy channel. So these days, obviously, there's a lot of talk about tariffs and trade restrictions. So that can have implications, of course, for the real economy, for credit risk, and thereby also for the banks. So that's an important channel. And then there's operational risk. So the security channel, if you want. Just one piece of evidence, cyber attacks have increased quite a bit over the past years, doubled in number over the past years, and also in terms of severity. So these are all financial risks, operational risks that banks need to deal with. Now, like you said, there's not, in many cases, there's not a simple risk model, and I'm sure this is also being taught here when you do your corporate finance. There's many risk models, but some of these things are really generic uncertainties, so we can't, squeeze them into a standard risk model. So this is why we're also working with the banks, that they have scenario analysis in place so that they can analyze different scenarios, what would impact their operations, which can be very different for different types of banks. So there's a whole range of activities that we do and that the banks are also doing to deal with these geopolitical risks.
One of the geopolitical risks is, for instance, the renewed trade tensions. And President Lagarde recently said that the euro area is generally well positioned to face uncertainties. We're wondering, what makes the banking system particularly well positioned, in your opinion, right now to face the uncertainties that we see with the second Trump administration?
Yeah. I mean, it's interesting when you look at the response of the markets to the announcements of tariffs. No, so and it was clear that, of course, there's a repricing of risk. Markets need to understand which sectors, which firms are affected most. So we saw in early April, we saw quite a bit of market reaction to these announcements. We have not seen relevant negative impacts on the banks. So this is, I mean, the first short-term effect. This is good news. I think it has to do with the fact that now the banks are more resilient, they're better capitalized, they're liquid compared to the situation, let's say 10 years ago when the banking union started, for sure, compared to the situation at the global financial crisis. But of course, we need to be very vigilant. So there can be risks in the non-bank financial sector that spill over to the banking sector. There can be vulnerabilities there. So we also monitor these short-term market reactions very, very closely. So that's for the short-term impact. But then there's also longer-term impact. Like I said, I mean, tariffs affect the costs of firms. They have an impact on the macroeconomy. So, and how exactly this is playing out, I think nobody here in the room knows. And if you know, then let me know. But I think it's very difficult to assess these longer-term effects. So this is why we advise all the banks, and I think the banks know, so their credit risk departments, they really work very intensively on this, that we need a better understanding of how the effect of the tariffs, the shocks, the change in relative prices filters through to the financial conditions of firms, the credit risk, and then also banks' balance sheets. So that yet needs to be seen. And I'm glad that the banks are more resilient so that they can also deal with potential risks that might materialize.
Yeah, and as you said, it's a very complex picture. And beyond direct trade channels, these risks may also come indirectly. So some banks rely on the US dollar funding, which can obviously dry up during the times of stress. Companies that borrow from banks can face problems with supply chains. Then there's financial instability in countries outside of Europe that can still affect European banks with operations there. It's a very complex picture. Are there any specific second-order vulnerabilities that keep you up at night?
Um, well, I think my role is to carefully think about vulnerabilities, risks, and what can we do. So I think it's always good to have a good night of sleep so that you're awake the next morning and can deal with these issues. No, there's nothing specifically that keeps me up at night. But I think because I know that we have a big system, lots of analysts who are looking at this, and we've been speaking about the role of the microprudential supervisors who need to make sure we have so-called joint supervisory teams who work very closely with the individual banks to understand the risks and the vulnerabilities of the individual banks and take measures in case we see deficiencies. But we also, of course, have big departments dealing with financial stability risks. So this is more the things that you spoke about, the vulnerabilities in the system and where could there be second round effects, spillover. So we have very good analytical work. And also you asked me earlier, do we have also tools to deal with systemic risk issues? Yes, we do. So if we just, one indicator, when we look at the capital requirements for the banks right now, we have seen not that much of an increase since, let's say, 2018, 2019, right before COVID, but we've seen a small increase in the macroprudential buffer. So this is the so-called counter-cyclical capital buffer. These are buffers that can be released in case there's a systemic stress event. So this is a response to the things we have been talking about, that we also need buffer space in the system in case systemic risk events happen. So we need both. We need the very detailed work with the individual banks, and we also need protection in the system to deal with systemic risk events.
And now, I think you mentioned that before, I would like to look at the specific sectors that are especially vulnerable and exposed to those external shocks. You can think about commercial real estate, small business lending, higher risk corporate loans, and these areas are also very politically sensitive because tighter supervision could mean restricting money in the real economy. So how do you balance this supervision without the risk of triggering concerns about restricting credit?
Yeah. Well, first of all, I have a very clear mandate, and the supervisors have a very clear mandate to keep banks sound and safe. And I think this is important, that we focus on our mandate. And as you said, there's many other political objectives you may have, but I think this is very clear. It's given to us by the legislation, and we focus on that mandate. So having said this, of course, supervisors and also regulators look at what could be potential unintended side effects of their action. No? And a lot of work has been done, and also empirical work, and maybe it's also taught here, or maybe, I don't know, if somebody in the audience is thinking about what could I do in my master or bachelor thesis, maybe that's useful work to follow up. A lot of work has been done to look at the link between capital requirements on banks and the impact on lending to the real economy, the availability of credit, and so forth. And the overwhelming evidence is telling us that, if anything, higher capital in the banking system leads to more lending, to more competitive banks. So because the banks that are better capitalized are more resilient, so this is good from a supervisory perspective, they also have more capacity to lend and to take risks. So this evidence is very clear, no? Of course, there was also work looking at what happens on impact if you introduce higher capital requirements. And then, of course, you have some banks who are kind of more constrained. And this is actually also the intention. So if the banks are operating at very low levels of capital, you want them to rather de-risk. No? But what many studies have shown is that then the better capitalized banks take over that activity and can lend more, so that overall the system does not constrain lending, and there's sufficient supply of credit to the economy. So this is being looked at, and there's lots of evidence on this.
We'd now like to move towards more of the internal fragmentation when it comes to the banking union. So the banking union has existed for over 10 years, and despite great success in the supervisory area, which we talked about, internal fragmentation remains. And there are multiple causes scholars outline, from home buyers, a lack of cross-border retail banking, to generally the EU's regulatory framework. We were wondering, given the success that we have seen in supervision, is rule setting still the way forward, or do we need to change strategy now to actually overcome internal fragmentation?
Well, we need rules to address the risks that can be there in the financial system. So I don't know how many of you remember the global financial crisis 17 years ago. So this was clearly also the crisis was the manifestation of insufficient regulation, insufficient supervision. So this is very clear. So we need the rules. And I would say when you ask about fragmentation, I mean, clearly what we do, what the SSM is doing is actually promoting integration, because as I said, we use the same standards. So if you're a bank in Europe, you want to operate across borders, you basically have the same supervisory standards. What we haven't mentioned, I think, is of course that we supervise the largest banks in Europe. There's also smaller banks called less significant institutions. They are supervised by the national authorities, but again, applying the same rules. So we have a single rule book, which is a great, if you want, a simplification initiative, because it's harmonizing the rules across Europe. No, so certainly nothing that we do stands in the way of more integration in Europe, but we still have many different national rules that also apply to banks. So if a bank wants to decide to give mortgage credit across different countries in Europe, there's many different rules applying to the mortgage market, just to give one example. And these rules differ for good reasons. There's different legal traditions and so forth. But of course, these are elements which are also segmenting the market. So I hope, we certainly very much hope in the ECB that now with all this discussion on capital markets union, further completing the banking union, we also get more harmonization of these different national rules. I think this would be a big stimulus to more integration, less fragmentation in Europe.
One of the aspects that you mentioned was the importance of rule setting. However, while we've made progress in the past decade on the importance of supervision in the traditional banking system, as regulation has tightened, financial activity has also shifted to the non-bank sector. And while we see now these efforts to incorporate and integrate the banking union continuing, there's a growing risk in the seriousness of vulnerabilities in the shadow banking sector.
Yeah, no, I mean, this is clear. I mean, this is what we've seen globally, that with the post-crisis financial sector reforms, there's also been an increase in activity in non-bank financial intermediation. To some extent extended, because risks might move to those parts of the financial system where there's better capacity also to bear these risks. So it's a useful diversification. To some extent, these risks have also moved to entities which are well regulated, like insurance companies. So if you take the whole non-bank financial intermediation sector, that's also including insurance. But some risks may also have moved to entities and to corners of the financial system where they're less transparent, where there might be high leverage. And this is really something that we focus on very intensively. So we've recently put out a blog on the growth in private credit markets, how also banks are linked to private markets, and how intransparent these links are sometimes. So this is clearly an area of attention for the banks. They need good risk management to manage these exposures, but I think also for the regulatory community, because we need better transparency also of those parts of the financial system where there could be vulnerabilities building up.
Yeah, because you said that those risks can quickly spill to the traditional sector, and we saw that in the UK pension funds during the glut crisis, or the margin calls after Russia's invasions on commodities. And considering this lack of transparency that you just talked about, right now, do regulators have the tools to catch these risks before they go systemic?
Well, I mean, this also needs to be done at the international level. No, there's a very intense work at the Financial Stability Board exactly on this, to also get the coordination, a better picture of what's happening in these areas, getting more reporting, better reporting also of these entities. And there's a lot happening in Europe also to have instruments that prudential instruments that can address systemic risk building up in non-bank financial intermediation. So yes, we need this. We also need a differentiated view because there's different financial institutions with different roles and different risk-bearing capacities, but we also need to monitor, that means reporting, and we also need to have prudential tools in case we see, as I said, vulnerabilities emerging to address them.
Mm-hmm.
Yeah.
I think now it's a good time to look at our audience and see if we have some questions. Yes, gentlemen in the front, get your microphone.
Hi, hello, thank you for coming, first of all. An important part of mitigating the propagation of systemic risk is having a credible and functional resolution system as well. And my question was, so to what extent do you believe bail-ins are actually enforceable in the current landscape? And if not, do you think it should be reformed or we should have a better resolution system altogether?
No, thank you for mentioning this because we discussed the two roles or basically the two pillars of the banking union before. So one is supervision, making sure that banks are sound and safe, but we shouldn't just think about the going concern, but we also need to think about the gone concern. And here I think it's really important to say that a lot has happened in the past 10 years. So when you look at the Single Resolution Fund, which is now filled up to the intended limit, when you think about all the tools we have in place, the resolution planning. So I think a lot has happened. And there was actually, I mentioned the Financial Stability Board earlier. There was an evaluation of the too big to fail reforms, which is much related to the resolution reforms a couple of years ago, which was showing that having credible resolution systems in place actually does have an impact on the incentives also in the going concern, so makes failure less likely. Then we do see an adjustment of market pricing to this reform. So there was a lot of positive evidence, and in the end, I think having a very credible resolution regime makes failure less likely. So maybe there was sometimes the argument we haven't seen cases of failure, but I think that's maybe exactly why. So having said this, and this is also what the Financial Stability Board report said, there's still gaps. And one important gap is currently, hopefully, being closed in Europe. It's a complex file which is currently being discussed in Brussels. It's called CMDI, Crisis Management and Deposit Insurance. And we have always said very clearly that completing these discussions on CMDI would bring more also mid-sized banks potentially under resolution, and also then providing the funding for this resolution. So we very much hope there was an initial proposal by the Commission, which we like, that the negotiations that are ongoing right now lead to the intended outcome that we're closing that part of the resolution framework. And then, of course, there's still EDIS. I don't know, I heard you had many discussions on similar topics here before. So this is European Deposit Insurance. So I think we also need to make progress on that file, because now it's, I think, the right time. Risks have been reduced in the banking sector, and I think we need to also make sure that depositors have the same level of protection across all countries. So I think this is a very important work that lies ahead.
But maybe let me build on that. Do you think that the lacking this EDIS in our system came from the fact that we didn't have enough protection before, or were there other? Because we often hear about European Deposit Insurance Scheme, and it was a discussion for a long time now. And do you think that this was because of the inadequate regulation maybe before, or maybe something changed now that we have this momentum?
Well, I mean, first of all, we have the same general rules also that apply to deposit insurance, but we don't have a harmonized system, no? So, and I think certainly when you have supervision at the European level, it also makes a lot of sense to have deposit insurance at the European level, because also supervision and deposit insurance, of course, go very much hand in hand. The original discussion at the start of the banking union, so this is deposit insurance is the third unfinished pillar of the banking union. The original discussion was also much around where we still have legacy assets and risks in the system, where people were concerned that these risks would be mutualized. No? So that was a very intense discussion at the beginning. And like I just said, risks have been reduced significantly. If you look at the number of non-performing loans on banks' balance sheets, they were on average around 7.5% 10 years ago. They're now around 2%, depending what exact measure you use. And this is even understating the progress that has been made in many countries where non-performing loans came down from about almost 50% to very low numbers. No? So this is why I said now is the moment, now that risks have been reduced, we have a single supervisor being effective, that this is now also the time to move ahead with EDIS, with European Deposit Insurance, because the preconditions are there to do it.
Yeah. Looking at our audience, do we have any other audience questions? Yes.
Thank you. Thank you, Claudia, for coming. I want to get back a little bit to fragmentation and geopolitical risks. There is a lot of discussion on geofragmentation, how it affects trade, but also how it affects the financial system. And you did a lot of research on international banking. And I wondered what your thoughts are, how this is going to potentially affect the European banks, because they tend to be quite international. Do you think this is an opportunity for European banks, or is there a lot of potential risks that you see?
Well, this is a tough question. So, I mean, several answers to it. So one, yes, I mean, if you look at the research on international banking, one of the things that is really striking is how biased the size distribution is, in the sense that, I mean, in each country we have a very biased size distribution of banks. So we have very few very large banks and then many small banks, and that of course also for Europe. And you see a similar pattern when you look at the international activities of the banks. Now you may say, well, this is then we should maybe focus our work on geopolitical risk on these largest banks that have a lot of international operations. And I think what is really interesting to see in the current environment is also smaller banks with a very local presence might be exposed to geopolitical risks through, for example, cyber attack, risks related to outsourcing. So many banks outsource their activities, so then the providers to which they outsource, they might be exposed to geopolitical risks, so there can be immediate impact. So this is why we're also working a lot with all banks to make sure that they have a sufficient resilience against these risks. Second part of the answer is, of course, there's a lot of discussions around Basel implementation, which is basically the Basel rules are for internationally active banks, that they have guardrails for their activities, that we have common minimum standards globally. And I think it's really important, as Europe is doing, to implement Basel, and many other jurisdictions, by the way, are also implementing the reforms. So I think this is really important too, and also a role that Europe can play to make sure that international standards are being maintained, that we have a level playing field across Europe, because that's the best way also to promote healthy international integration of markets, so that we don't get exposed to the risks from international activities, but can really share the benefits. Risk sharing was mentioned, of course, that's a big benefit of international activity.
Yeah. And let us move back to the interview. Thank you for those audience questions. And on the topic of risk sharing, of course, right now we have another momentum for Capital Markets Union. And in recent years, Mario Draghi and others have argued that deepening capital markets is essential for private risk sharing to reduce reliance on banks that they bear. Do you think that we needed Trump's second presidency to realize that the CMU is not only some project, but a core issue for Europe?
Well, I think the policies that are decided in Europe should be decided in the interest of Europe. And I think there was a lot of things that had been discussed already many years ago. And we mentioned EDIS, we mentioned the Capital Markets Union. And I think it's important that Europe generally is responding to geopolitical developments by strengthening the single market, reducing barriers to integration. I think the Capital Markets Union project is important. Not just it's not a substitute for bank lending. So many firms, corporates in Europe rely heavily on bank funding. So this is a bit also the structure of European financial markets. but we also have many long-term investment projects that need to take place under a high degree of uncertainty. So we also need a role for equity finance. It's very complementary to bank lending, and I think this is what Capital Markets Union wants to achieve, so that we have both bank funding from markets, equity markets in a stable, in a sustainable way. And I think there's many synergies between these projects.
Because we often talk about Capital Markets Union also in the context of enhancing Europe's competitiveness, but from your role, do you see underdeveloped capital markets primarily as a financial stability risk?
Well, there's different aspects to your question. So one is, I think we need to be very careful that we don't start deregulating in banking markets, that we have weaker standards when it comes to resilience in an effort to promote competitiveness. So I would say it's rather the opposite. We need to maintain the standards in terms of resilience, capitalization that is promoting competitiveness also of the European banks and also of the real economy. Now, so that's one part, how regulation and competitiveness are linked. And the second question you asked is about, do we need a more diversified financial structure? Is this enhancing in terms of financial stability? And I would say yes. So if we discussed earlier that there's also, life can be risky, and this particularly holds for financial markets. So I think if we address the risks that are also in other financial market segments, if we address this, if we have a diversified funding structure, that's always good for financial stability, of course.
Yeah.
However, it's often argued also that EU's capital market is more like 27 loosely connected national systems in that regards. And how do we move forward in regards to that integration then, when the legal infrastructure, which still separates it into these national loosely connected markets, continues to stay along national lines?
Well, that's in the end for the politicians to decide where exactly do they want to move forward. So what we do as supervisors, we also inform about what are relevant national regulations that might impede a further integration of markets, where are areas, for example, we are now working on how can we further simplify, make supervision more effective, more efficient. And one element of this is also reporting. So we can say, well, where are areas where national reporting, European reporting duplicate, overlap, so that there could be improvements in terms of efficiency, simplification. So we can't take the decisions, but we can, of course, inform the policy debate of where relevant areas of fragmentation that could be harmonized.
Closing the topic of the CMU now, one last question. So many argue, we also talked about the importance of equity just a second ago, that Europe lacks an US-style equity culture in that regard. So we're a different economy with different generous welfare systems, risk-averse retail investors. So how much of this challenge is actually more of a political culture than just a simple policy design?
Not sure whether I fully understand the question, but I think it's what you're asking is that we have different financial systems, different preferences, and across countries. Well, I think this is to some extent it's healthy. It's part of the diversity that we have, not just across the Atlantic, but also within Europe. When you look at how what banking sectors look like, what financial systems look like, we have diversity. So this is good. This can also be stabilizing. I think what we need to make sure of is that there's no barriers to integration which would actually be detrimental to welfare enhancing integration initiatives. So I think in the end we will always keep national peculiarities, and that's also nice. This is what Europe is about. But of course there can be barriers which are impeding the free flow of funds and a better, more diversified, more integrated system.
Mm-hmm. And however, the institutions constructing the European banking system, such as the European Banking Authority, European Central Bank, SSM, are aimed at stability and supervision. Who do you think is going to be the driving force pushing for more competitiveness and growth in the European Union?
Well, I mean, there's a lot of, as we just discussed, I mean, there's a lot of political decisions and discussions around it. And I think the reports you mentioned, the Draghi report, the Letta report, give a lot of information of what can be done to promote growth, to promote competitiveness. So it needs to be seen what also who sets the political priorities, what will be decided upon. And as I said, we can just we can say what is our contribution to this. And as I said before, I think the best we can contribute to sustainable growth, financial stability, is to make sure that the banks are sound and safe. And that's what we do.
Perfect. So as we're wrapping up this interview, we've talked about the many risks to systemic stability in this interview. However, there are probably some that journalists and the general public to an extent overemphasize, not because they're unimportant, but because they maybe get more attention than they deserve. Do you think there's such a topic for you?
Well, I mean, public outreach and explaining what we do is extremely important for us because, and this is actually also one of the reasons why I'm here and speaking to you today, because what we do, what supervisors do can be technical. It needs to be technical because banks are complex institutions, so we need to understand them well. We need to make sure that what we do is legally sound. But there's also a broader dimension of what we're doing. So making sure that we have financial stability, that we learn the right lessons from financial crisis, not just the last one, but actually a history of financial crisis, that we don't make the same mistakes again and keep the system resilient and safe. This is what we currently have, but we also need to look at risks. You asked about forward-looking risk assessment. We need to also think forward and what could be vulnerabilities, risks affecting the system. So, and it's important that we also have this public support for the work that we are doing.
Thank you so much, Chair Buch, for this interview, and it was a pleasure to host you on our stage. And also thank you to our audience for listening over this past hour.
And Room for Discussion will be back after the summer break, and throughout the holidays you can obviously watch interviews on our YouTube channel or listen to our podcast on Spotify. But for now, let's thank Chair Buch for this wonderful hour with us.
Thank you very much.